how do you navigate markets during these volatile times? Well, Mark Heffernan joining us from Ord Minnett. Mark, welcome to Ausbiz. Good to have you on the show. Now,
thank you, Andrew. Good to be here.
Times like this don't come around very often, do they? So, what do you need to be mindful of as an investor?
Yeah, what we're talking to clients really about in these times is that, and trying to put into perspective of where we've come from. It's been a really period of 2 years of strong growth in markets, and where we were, I guess, heading into Liberation Day, if you call it, is that markets were quite overvalued. And we have a look at the US market. It was trading at around about 22.5 times price earnings ratio on a 1 year look forward. And that was about a 2 standard deviation move. So a really extreme valuation at the moment. And that's starting to come down now, which is pleasing from our clients' perspective. But really what we're really focusing on is that client portfolios really need to be diversified at this point in time. So a lot of the talk is around the US markets and the Australian markets, but having a real diversified portfolio can really help to protect portfolios in these times. And on the day of Liberation Day, if you want to call it, we saw whilst equity markets were declining, fixed interest really did protect portfolios. And we saw really big moves down in bond yields. And as bonds are inversely correlated to yields, the bond price went up. So that really helped to protect client portfolios, as well as looking towards other asset classes such as alternatives and private markets and absolute return hedge funds really can protect portfolios during these times. So certainly isn't a time to panic, but it is certainly a time just to be cognizant of where we've come from and what we're experiencing at the moment.
So what do you see, Mark, as an appropriate balancing at the moment, particularly, I guess, if we refer to equities and fixed income in that 60-40 ratio?
Yeah, look, Andrew, it really depends on that client scenario. So we deal with a range of clients from real young accumulators all the way up to retirees and family office. So each client will have their own risk profile and their own preference and tolerance for risk. And I'll give you a bit of an example about that. So for our clients in pension phase that are relying on an income to draw from their portfolios, it's really important that they do have enough cash and liquidity in their portfolio to try to prevent those scenarios where we do need to sell down to realise cash. So sometimes for these clients, holding around about a year's worth of cash for their pension payments is really important. But at the other end of the spectrum, your business owners, your entrepreneurs, your C-suite executives that might have a little bit more tolerance for risk, and they're able to accept these drawdowns and in fact see them as opportunities. You might hold more of your equities and your growth assets. So we sort of look at it from a client perspective and their tolerance for risk, and from there we're able to build portfolios. But on top of that, we do take a real sort of granular look at what's going on in markets and how can we position those portfolios to best protect their wealth, but also grow it. And to give you an example, at the moment, as I mentioned before, the US market was quite overvalued heading into Liberation Day and even heading into really our sort of February highs. So looking to reduce your exposure perhaps to the US and looking elsewhere across the globe. Australia is only 2% of global markets. So whilst a lot of talk around Australian stocks is important for our clients, we do take more of a holistic view. So Japan and Europe really are starting to become quite attractive from that perspective. As I mentioned before, fixed income can really balance out your overall perspective. So it's really not a one-size-fits-all option that we look at clients. We really do build those portfolios from the ground up.
When you look at those markets, are you trying to factor in the effects of tariffs, or is that simply too difficult at this point?
Yeah, look, it's certainly a discussion point, and it's a factor that we do need to consider. Now, really what we're sort of communicating to clients at the moment regarding these tariffs is that what it is creating is a hell of a lot of uncertainty. And we know from experience that markets don't like uncertainty. And at the moment, and on Liberation Day and the following day, it really was just a sell now and ask questions later scenario. And look, what we see happening, if we take Trump's policy, or if we take Trump as the person aside and we just actually have a look at the policies of the Republican Party, we have observed over the last 2 years that there is a a real build-up of US debt and interest payments that was needing to service that debt. And the US deficit spending was around about $2 trillion as Trump headed into power in November. So it needed to be wound back because it's going to be our kids and the kids across the globe that are going to be paying this. So what he is trying to do in one way is he really is looking to reduce that down, which you could argue is a positive. But the way he's trying to do it, it does appear that, look, it's as though he's trying to turn the QE2 around in 180 degrees as though it's a jet ski. He's trying to do it over a couple of months, which it may take a number of years to effectively implement. So it certainly is a discussion point for us, and it does bring about a lot of caution in markets. But we do need to be aware that if you've got that long-term mentality and you're not here to buy on Monday and sell on Tuesday, it's a factor we need to consider. But this is just another hurdle that we'll need to get through as investors, as we've done over many, many years.
So, Mark, you've spoken of the importance of diversifying your portfolio with a mention there of alternatives. What are you looking at, particularly in terms of private markets?
Yeah, look, it's been a really attractive asset class for our clients to really protect portfolios during times of stress. So we saw during 2022 and even in the COVID days of 2020 that alternatives can really provide that buffer. So what I'm talking about there is a range of investment offerings. So we're looking at private equity, both from real sort of large cap private equity buyout firms all the way down to secondaries, which can become quite attractive. Having a look at absolute return hedge funds that do have the ability to profit in both up and down markets. I'd put infrastructure into that category as that real sort of defensive alternative options. So there are a range of options we can deploy for clients, and we have been deploying for clients through the cycle that can protect your portfolio. And the way that we describe this asset class really is the asset class that's not correlated to equity market returns. So even as equity markets do draw down, we can potentially have a pool of funds that can best protect your portfolio.
And Mike, you've spoken of the difficulty in terms of timing selling. What about buying, particularly where we're at the moment? Clearly investors asking the question, well, how do we know there's a bottom? When's the time to get back in? Potentially, we're seeing some of that today with investors clearly trying to pick up some bargains.
Yeah, again, I like to use history as an example with clients. And during the dark days of March and April in 2022 during COVID, our market fell around about 34%. So at the moment, we're around about sort of 12 to 14% decline from the peak of about 86.15, I think it was on Valentine's Day. So putting it in perspective, this is really just part and parcel of a normal market drawdown. We get 10 to 15% corrections every few years. So really, we're not in the game of trying to pick the bottom. We're in the game of really just focusing on that long-term objective and seeing that at the moment, if you've got funds to deploy, then 14% lower than where it was previously is not a bad option. But really trying to communicate to clients that it may not be the bottom, and we're not in the effort of trying to pick that bottom. And if you cast your eye back 5 years, for example, in the throes of COVID in March and April of 2020, things looked really bad during that time. If you looked out the window, the whole world was locked up in their homes, and obviously there was recession talk, and that was actually the bottom of the market and the time to invest. So trying to pick that can be inherently hard. But if we step back and say, look, over the last 10 years, these are the events that we've endured. If we have a think about the end of 2015-16, we saw a real big commodities rout where the Chinese yuan devalued considerably, and we saw BHP at sort of $13, $14. Then we moved into 2016 and Donald Trump came into power. 2018, we had the scenario of the US Fed trying to increase interest rates. 2020, we obviously know the events of COVID. 2022, we had the fastest increase in interest rates on record across the globe, and here we are now. So it's just another event, as I said, another hurdle that we need to step through, and this is where the role of the financial advisor is critical in these times. Really, as financial advisors, we lean into these scenarios. So it's communicating to clients, whether it's face-to-face meetings, whether it's phone calls, whether it's just your standard newsletter or email, just to let them know what is going on. that your portfolio, it may be well positioned for this, or we might need to make some adjustments. But trying to pick that bottom and trying to get that timing right is incredibly hard. And sometimes it's timing the market as opposed to timing the market.